let's go straight across to Sanjeev Prasad, who's now with us, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good morning. Great to have you back on the program. Thanks very much. And, wishing you all the best of luck for the conference. And I think you'll get, I'm sure, lots and lots of questions. You were, of course, early on and steadfastly cautious through, I dare say you were wrong for a while. But I think now, of course, it's out there for everyone to see. So where does, after what we've seen in terms of the correction, the small cap index has lost about a quarter of its value from the highs. The mid cap index has lost about 20% from its highs. Where does it leave us, pure valuation-wise, Sanjeev?
Well, it's the same thing which we have been saying for the last 1 year or so. And if you look at the valuation of the large cap index, let's say the Nifty 50 index, it's not too bad, roughly about 20 times 1 year forward, about 7.5 on a March 27 basis. There will be earning downgrades, I'm sure, in some of the sectors. But broadly speaking, I don't see too much downside, as far as the large caps or some of the large caps are concerned, namely the financial names, IT, pharma, etc. Yeah, there are still pockets of overvaluation even in the large cap, but I can live with that. The problem still remains in the mid cap and small cap, areas that is sector dominated by mid cap, small caps, or the mid cap, small cap stocks. Still a lot of froth over there, and I think you would see a lot more correction over there because the fundamental value of many of these companies are far lower than whatever the current market caps and prices are. I mean, you talked about RVNL. Just now. I mean, the market cap of the company is something like 75,000 crores even now, by the way. Huh? I think it is still at about 8 times book value, if I remember the book value correctly. Yeah? And about 40 times on March 24 profits. And the railway budget this time around, there's no growth in the railway budget, right? So where is the growth going to come from for some of the railway stocks which had become very, very expensively valued? So there are still pockets of, I would say, froth in the market, and that will get flushed out over the next few weeks. Looks like the way the market is going.
Sanjeev, I was looking at this data point in the morning. If you look at the small cap index, right, with this correction we've seen, the 10-year CAGR now has fallen to about 11%, which is in line with the long-term average now. The mid cap CAGR 10-year is now about 14%. Is 14%. Again, it doesn't seem, I mean, that excess or excessive kind of fraud seems to be out. But of course, these are averages. The other point is markets rarely settle at averages, right? They overshoot and then they undershoot. But you're saying on an absolute basis as well, and you gave us that example of RVNL, there are large pockets of overvaluation and excesses, right?
Absolutely. Yeah. There are just so many stocks here, especially in the mid cap and small cap areas, So either you have, companies which are trading at very expensive valuation but have decent fundamental. These are the high growth companies, let's say in the capital goods space, EMS, etc. But we just struggle with the valuation of these companies, and they are so much priced to perfection, even now, by the way, despite coming, down 20-30% from their peak level. So any disappointment, you would see a big, cut in the market price over there. And then you have many other stocks which are not displaying any great, numbers, especially on the consumption side, and the valuations are still very, very rich. And in most cases, the multiples are significantly higher than the pre-COVID levels, and the growth is significantly lower than the pre-COVID levels, so which makes no sense really. And in many cases, you are seeing a lot more disruption, medium-term challenges, structural issues cropping up, which were not there 5-7 years back when the market was willing to give much higher multiples to the same sector in stocks. And then you have a bunch of completely irrationally valued, sectors and stocks which have no real fundamentals, but the prices have gone up very high for whatever reasons, and now they are giving way, and these will correct really, really badly, and unfortunately a lot of retail money is over there from whatever I have looked at some of these stocks.
Which are these, Sanjeev? The ones that are looking absolutely still insanely overvalued and where earnings are just not justifying?
Just
which pockets? I mean, if not stocks, which pockets?
Some of the PSU. Look at the PSU names in railways, metals. You will get a very good sense.
Okay. By the way,
I mean, not the large cap ones like let's say
Yes, please continue.
Saying that
Please
NTPC,
continue.
Power Grid, etc. may be okay, more reasonably valued now. I was just saying NTPC, Power Grid, etc. may be more reasonably valued. But look at something like a BHEL, which we have been sounding cautious for the last 1.5 years now. The stock went up from whatever, less than 100 to 300, now down to below 200. I still think it's supremely overvalued. It will come to below 100, or rather I should say, I can't forecast stock prices. The fair value of the company is below 100 in my view. Right? Still my view, but that's what it is. And I can give you the math on that, but anyway, let's keep it for a
Got
second.
it. You're saying even within PSUs, there are the likes of NTPC and Power Grid where you think now the corrections made the prices a little reasonable, but BHEL you'll hold your verdict on that one. By the way, just want to report that from a very sharp gap down, now there's an equally quick recovery in the market as well. Should take note of that. There's a V-shaped recovery right now on stocks like Bajaj Finance, Tata Motors, Apollo Hospitals, NTPC, the stock that Sanjeev was just talking about. So we had this slam dunk, and now the buyers have quickly crept in, and those charts are suggesting that. Sanjeev, just very quickly, at a headline level, I was looking at, for instance, some of your peers, Motilal's note, they were saying for FY26, the Nifty estimate is around, I think, 1203, 1,203. And they feel that expecting a 15% CAGR is very excessive right now. Where are you on the headline earnings trajectory for FY26? Whether it's the Nifty 50 or the BSE 200, some of the wider indices, what is that big number that you are going with?
So for FY2026, we have 14.9 or 15% growth, let's say, rounded out to 15%. That's on the back of 4% growth in FY 2025. But anyway, 2025 numbers are distorted by, much weaker numbers for the likes of BPCL, HPCL, which is not part of Nifty, but through ONGC, these numbers come. And also coal had very high numbers in FY 2024. We will have a big decline over there compared to FY 2024. So if you look at without these three companies, which is probably right to look at it because there's a lot of volatility in the numbers of these three companies, then the FY 2025 net profit growth will be 10%. And for FY 2026, now, as of now, we have 14% growth. And I think the EPS number is about 1180 or so for FY 2026.
You're
so
saying
again, the Nifty is not a problem. If you look at the banks are reasonably...
Sorry, Sanjeev, you're saying the Nifty...
14% growth if you take...
Yeah. And X of which companies did you say that the growth number comes down to 10%?
BPCL, HPCL and Coal India. HPCL is not in the Nifty, but its numbers get consolidated with that of ONGC, and ONGC is in the Nifty 50. And there's a lot of volatility in the numbers of these companies. By FY 2024, if you recollect, you had very, very high profits for BPCL and HPCL. And also coal had this one-time benefit from the change in their accounting policy for the overburden removal, which boosted 2024 numbers significantly. Which is why if you look at the FY 2025 headline number, it is only showing a 4% growth. So that's why we now remove BPHP and coal from the calculation completely. And if you do that, then the FY 2025 Nifty net profit index, Nifty 50 index net profit growth comes to 10%. And on a like-for-like basis for FY 2026, it comes to 14%. So there will be some downgrades, but I think 12-13% it seems achievable for the Nifty 50 as a whole. See, Nifty 50 again is not a problem. You have companies, like the banks, etc., which are not seeing really any challenges as of now. Or especially the banks which are Nifty 50. There are smaller banks who are seeing a lot of issues in the MFI, loan book, and so on and so forth. But there are no real asset quality issues as far as the larger banks are concerned. If you look at IT, pharma, which are another very large portion of the index, they are getting some tailwinds from the big INR depreciation that you have seen, and some recovery, and anyway, pharma companies are doing quite okay. So that's not the problem. The real problem, as I keep saying, is beyond the large caps.
Okay, all right. Hi, Sanjeev. Good morning, and always good to hear your thoughts. And congratulations, actually, on being a little bit cautious, particularly calling out some of these PSU names. You were in minority actually at that point of time, but a lot of this has played out. But let's talk about a couple of spaces that I think you are fairly okay on in. Quick commerce, Zomato, everyone was very, very excited about it. It could be one of the stocks that come into the Nifty as well. That stock has pulled back a goodish bit. Even Swiggy, after it listed, the stock went up 50%. And now it's below the IPO price. What's your view on this quick commerce theme? It's making consumers' life a lot easier, but from a shareholder perspective, what's your view?
No, we continue to like the space. See, these are long-term growth stories. If you look at, let's say, food delivery business, It's now a nice market, only two companies now basically, Zomato and Swiggy. And if you look at the growth drivers over there, unlike, let's say the FMCG companies who are seeing a lot more competition coming in, fragmentation of market share, etc., here you don't see any of those challenges. So you are seeing, a triple combination, I would say, of more number of users, more frequency of usage, and higher AUV, that is average order value. And each of these levers, if you take 3-4% growth, which should be quite achievable in India, in a country like India, given its growth prospects, the combined growth actually becomes very, very decent. We are talking about 15% plus in that case. If you have three levers, each growing at 4% plus, that's the kind of growth we are looking at. The challenge remains on the quick commerce side because obviously this market structure is still not evolved. You're seeing a lot of competition, a lot of cash burn over here. I think it's a matter of 1 or 2 years before things start settling down. Obviously, things could get a bit more nastier over here. So that's why I keep saying, you have to look at these companies from a more long-term basis. The growth is there. The structural story is very, very powerful, both in the food delivery and the quick commerce part. But yeah, things could, given the challenge around the quick commerce business, the path to profitability has got, extended now. Compared to earlier, we were looking at, let's say, break even in 12 months' time. It will probably be more like 24 months' time for all you know. I mean, I don't know. It's still evolving, the whole space. And we don't know what the likes of the e-commerce players will eventually do over there, or the modern retailing guys, what they will do over here. So you could eventually have a 6 or 7 player, a market, all fighting, for the consumer wallet. And, things could remain, in a state of flux for some more time. So yeah, so that's what is reflecting in the stock price currently, not the concerns around long-term, any challenges,
All right, no, absolutely. Sanjeev, the other question, and you'll have so many foreign investors also at the conference, right? Foreigners have sold some $21 billion of Indian stock from the peak in late September last year. So this year, I guess, we're giving back some of the crazy run over the last few years. But global equities generally seem to be, we're looking at Europe, for example. The Euro Stoxx 50 has come back to its same level as year 2000 after 25 years. Things are rising from the dead. China, for example, has started on a good note. Mostly tech, though. Does this mean more competition for this foreign capital? Because there was this argument which was made last couple of years that, there's only US and India, and that played out, for a while. Where do you stand on foreign flows, Sanjeev, from here on?
The foreign flows, I suspect, we should assume for the time being it's not coming back in a big hurry. And the reason for that is pretty simple. There is no new money coming into emerging market funds for the time being. And I don't see why that situation should change in the next 2-3 months at least, given the fact that the US market is doing very well. We have a lot of, policies which are still evolving, as far as the new US administration is concerned, which could work against the EMs for, if you see more, tariff being put on exports from some of the emerging market countries. So as of now, I would say most asset allocators would be a lot cautious on emerging market. And that's been the theme for the last, 3-4 months now. This whole thing started from late September when, first of all, I'm talking more from India perspective, first you had the India to China pivot, when China announced a host of policy measures, fiscal and monetary, to reboot the economy. And very quickly, by end October, when the chances of Republican Party winning all the 3 arms of the US government, started to build up, the so-called Trump trade, you had a pivot from EMs to the US. And that trade, unfortunately, has continued, from a perspective of EMs. And you see the fundamental problems still remain the same, right? If you look at the performance of emerging markets, it's been a disaster for the last 10 years. The MSCI EM index is up 13% in the last 10 years, cumulative that is, which means 1% CAGR. Against that, the S&P is up 200%, so that means 3x. NASDAQ is up about 300%, that means about 4x, by the way. So that's the comparison an asset allocator, which could be an endowment fund or a pension fund, something like US is looking at. And everybody looks at trailing returns, and decides, okay, fine, US is the market to be in. Plus, you don't have worries about, currency and so on and so forth. So why bother? And I suspect that may continue till the time either something goes wrong in the US, but obviously then it means pain for the rest of the world also, or somewhere EM valuation come to a level where people start looking at a lot more favorably, which is what seems to have happened in the case of China at least. Valuations were attractive. Certainly, you have this excitement around DeepSeek and AI-related tech. We have seen all the tech companies bouncing back, and all of a sudden China has decent tech companies. So that is the excitement now. But remember, it is basically the same money which is rotating between various EM markets. And unfortunately, India will not get any money in the process, because if China's market is doing well, India will probably struggle, which is the second leg of the problem. So first you have an EM to US problem. Second is, as of now, looks like again you have India to China pivot, which is going on.
Absolutely, and that's showing up in those numbers, right? I mean, 14-15% up in the Hang Seng, multiple wars, and that's a real sobering thought, Sanjeev. Final question, where does it leave us then? Does it leave us, is the best case a time correction? The market does nothing, spends the whole year consolidating. Is that the best case? Or is there still the possibility of seeing more downside, despite the mutual fund support that the market has got the last so many months?
It ultimately depends on how the retail investor, takes this period of pain, which has been there for the last 12 months now, come to think of it. If you look at the Nifty 50 mid-cap index, Nifty 100 mid-cap index, I think it's up only 3% in the last 12 months. Nifty 100 small-cap index is actually negative last 12 months now. So, and the last 3 months have been pretty ugly for both mid-cap and small-cap indices and stocks. See, there are some interesting data points. If you have the time, I will share. See, there are two issues over here. When people believe Indian retail investors have done very well, keep in mind the fact that you have a lot of new investors who come to the market in the current financial year. About 8 million out of 53 million unique mutual fund investors have come in the last 9 months here. And these are investors who I don't think will have the risk appetite to bear a big market correction. So how they are behaving, I don't know, but I'm sure there could be some signs. I suspect there could be some signs of panic over there. The second more interesting data is when the money has come into mutual fund, by the way. So if you look at last year, that is calendar 2024, 4 trillion rupees came into mutual funds, equity mutual funds. And that is not very different from the cumulative numbers of 21, 22, 23. 1 trillion in 22, 1.6 trillion in 22, 1.6 trillion in 23. So that's about 4.2 trillion. So the more important point is, if you look at the weighted average price of acquisition of retail investors, it's actually quite high, not as is made by the return. So it's not as if retail investors sitting on a lot of great returns. When they put money also matters. Who has come into the market of late also matters. There is
so more downside. So is there more downside?
I don't know. I don't know, Baba. See, who knows the point of retail investors, right? If they are reasonably, confident about the future, they stay invested. But if they start panicking based on whatever we have seen last few weeks, then I don't know what's the bottom of the market in that case.
Number is, Sanjeev,
especially
8
for some
million.
of the low quality, low liquidity.
Yeah, 8 million out of 53 million
I'll give you the data
MF
again.
investors.
Yeah.
Sorry.
Yeah. Came in the last 9 months, and they are probably all lost money.
Yeah. And the other point.
Market is down since then, no? So clearly they have lost money.
Yeah.
4 trillion rupees has come in calendar 2024, which is similar to the entire money which has come in calendar 21, calendar 22, calendar 23. So the point is the weighted average cost of acquisition of stocks through the mutual funds is actually high. It will not be very low. So the index looks very good on a 3-year basis. I don't think individual portfolio returns will look that good on a 3-year basis, because when you put money also matters, right?
Absolutely.
If you have put money in 21, you would be sitting on a lot of gains. If you put money in 24, you have lost money actually. Absolutely. And if you put more money in 24 versus in 21, then your average return will still be not that great, right?
Absolutely.
The question is, if you put in 2025, is it a right?
The retail investor has to deal with.
The question is, Sanjeev, is in 2025 you're getting a bit of a dip. How much more pain will you make money from here on? That's going to be important as well. The entry is extremely important. And sometimes, periods like these, it's anyone's guess which one it'll go.
It's a long way to go. For the mid cap and small caps, be very, very careful. Yeah.
Got it, Sanjeev. Appreciate.
Ultimately, you have to be very focused on value. Yeah. Okay. Thank you.
Absolutely, Sanjeev. So maybe. The large caps could be protected to some extent, but mid and small caps, there could be a lot more pain in store. Thanks a lot for joining in, Sanjeev, and giving us some of those sobering thoughts as well on the markets. By the way,